The market can be viewed as a competitive arena. Retail traders and institutions are the key players in this arena. Retail traders typically operate with fundamental tools and limited resources. Institutions possess advanced resources and sophisticated strategies. A key difference lies in their objectives. Retail traders aim to win, while institutions focus on risk management. The market is inherently neutral, lacking optimism or pessimism. Survival, not rapid enrichment, is the key objective in the market. Understanding the causes of failure is crucial for market participants. The market structure is designed to induce failure in many participants. Analyzing market structure helps in understanding potential pitfalls. Focus on risk management and understanding market dynamics for long-term success. Every trader must consider two fundamental questions before making any decisions. The first question is, how much profit can I potentially make from this trade? While enticing, focusing solely on potential gains can be a risky approach. The second, more strategic question is, how much capital am I willing to risk losing on this trade? Prioritizing risk management, though uncomfortable, is crucial for long-term trading success. The market reacts differently to potential gains versus potential losses. It tends to penalize decisions focused solely on potential gains. Conversely, the market respects and rewards consideration of potential losses. Decisions driven by the prospect of gain are often influenced by emotion. Strategic thinking and planning are key when assessing potential losses. Therefore, a balanced approach considering both gains and losses is crucial for market success. The market functions as a system designed to extract profit psychologically from participants. Holding on to losing positions is not an act of patience, but rather a state of captivity. This captivity stems from emotional attachment and the unwillingness to accept losses. Such psychological biases can lead to suboptimal decision-making and financial detriment. Averaging down is the practice of buying more of an asset as its price decreases. This strategy is typically employed in losing trades to lower the average purchase price. However, averaging down is not a sound investment strategy. It essentially involves arguing against the market's indication that the initial investment thesis was incorrect. Instead of investing, it becomes a negotiation with contradicting evidence. Premature profit-taking involves exiting winning trades too early. This action prevents the realization of potentially larger gains. It can lead to missing out on life-changing trends. Exiting early is not securing profit, but limiting potential upside. Patience is required to maximize profits from successful trades. Many traders fail due to an emotional rather than operational relationship with risk. An emotional approach to risk often results in flawed judgment. This contrasts with an operational approach, which is more systematic. Therefore, understanding the difference is crucial for effective trading. Retail traders often operate under a misconception regarding market liquidity. They commonly believe they can seamlessly enter and exit positions at a reasonable price. This perception is often inaccurate and can lead to unexpected losses. The reality of liquidity is more complex and varies significantly across different assets and market conditions. Entering the market is straightforward due to retail traders offering exit liquidity. Informed participants can easily find counterparties to close their positions. Exiting becomes challenging when a trader's position is incorrect. Liquidity diminishes, making it difficult to find buyers or sellers at desired prices. The concept of a fair price is not a fixed or objective measure. Price should be viewed as a point where a transaction occurs. It is not necessarily tied to the inherent value of a product or service. Price is determined by various market factors and negotiation. These factors include supply, demand, and perceived value. Therefore, price is a dynamic agreement rather than a reflection of intrinsic worth. Liquidity in a market is closely tied to the strength of consensus among participants. When there is strong agreement and confidence, liquidity tends to be abundant. However, liquidity diminishes when conviction becomes costly or uncertain. This highlights the sensitivity of market liquidity to shifts in consensus and risk perception. Panic candles are market phenomena characterized by rapid and significant price declines. These declines are visually represented as large candles on price charts. The primary driver of panic candles is an imbalance between market entries and exits. Specifically, panic candles form when the volume of market exits overwhelms the volume of entries. This overwhelming exit volume creates intense selling pressure. The formation of panic candles is not solely attributable to increased market speed or volatility. An edge is defined not by advanced analytical skills. Instead, an edge is fundamentally about the effective execution of self-control. Self-control allows for consistent adherence to a defined strategy. This consistent adherence, in turn, leads to a behavioral advantage. This advantage stems from disciplined decision-making and action. Therefore, self-control is the cornerstone of gaining a competitive edge. Traders are compensated for accurately identifying market confirmations of their investment ideas. Payment is contingent on recognizing concrete evidence supporting a trader's initial thesis. The ability to predict market movements alone does not guarantee financial reward. Profits are realized when a trader's analysis aligns with actual market behavior. Therefore, recognizing confirmation is the key to financial success for traders. Traders reduce exposure when their initial market analysis proves incorrect. This reduction in exposure is a risk management strategy. The market's behavior invalidates the trader's original thesis. Cutting exposure minimizes potential losses from adverse market movements. Traders are compensated for this risk management through trading profits. Traders are compensated for their ability to take decisive action. Decisiveness implies acting without prolonged internal debate. Hesitation can lead to missed opportunities in trading. Quick and informed decisions are valued in the trading environment. Payment structures often incentivize rapid response to market changes. This rewards traders who can swiftly analyze and execute trades. Professionals focus on managing risk through a structured approach. Capital preservation is the primary goal for professional risk management. Loss containment strategies are crucial for limiting potential downsides. Position sizing is carefully considered to manage exposure. Timing confirmation helps validate investment decisions. Profit expansion is pursued after managing risks effectively. Amateurs often invert the standard risk pyramid in their decision-making processes. This inversion leads to prioritizing potential profit over risk management. Common factors contributing to this inversion include indicator overload and narrative bias. Emotional attachment to positions and forced execution further exacerbate the issue. This approach contrasts with professional strategies that emphasize risk mitigation as paramount. An inverted risk pyramid represents an inherently unstable structure. This instability arises from the pyramid's foundation being narrower than its upper layers. Due to its design, an inverted risk pyramid is prone to collapse. The collapse signifies a failure in risk management and structural integrity. Retail traders often underestimate the importance of a 1% risk allocation per trade. Professional traders recognize 1% risk management as a cornerstone of long-term survival. Consistent, controlled risk exposure is vital for weathering market fluctuations. Prioritizing longevity over high-risk, high-reward strategies ensures sustainable trading practices. Risking a significant portion, such as 20% of one's capital in a single venture, can be perilous. A single incorrect decision with such a substantial amount at stake can lead to severe financial consequences. The potential for loss is magnified when a large percentage of capital is concentrated in one investment. If the investment fails, the resulting loss can be devastating to one's overall financial standing. Such a loss could potentially lead to financial ruin, depending on the individual's overall financial situation. Diversification and smaller, more calculated risks are generally recommended to mitigate potential losses. Risking 1% of trading capital per trade is a risk management strategy. This approach limits potential losses on any single trade. Even with 10 consecutive losing trades, the trader retains a significant portion of their capital. This allows for continued participation in the market. Consistent application of a small risk percentage protects against rapid depletion of funds. It also provides opportunities to recover losses and capitalize on future trading opportunities. Asymmetry in trading refers to the potential for gains to significantly outweigh potential losses. Risking only 1% of trading capital on each trade is a risk management strategy. This approach limits potential losses on any single trade. Holding on to winning trades allows them to potentially generate substantial profits. The combination of limited risk and the potential for large gains creates asymmetry. This asymmetry works in the trader's favor over the long term, increasing profitability. Variance in trading outcomes is influenced by the level of risk taken. Committing 20% of capital to a single winning trade increases exposure. Holding such a position amplifies the potential for variance to negatively impact the trader. Higher risk levels correlate with a greater probability of adverse variance affecting trading performance. Courage in finance is not solely about the size of investments. It is more about maintaining solvency. Solvency provides the ability to withstand market fluctuations. This resilience allows for capitalizing on rare, highly profitable opportunities. Therefore, true courage lies in the ability to remain in the game long enough to benefit from outlier events. Sideways markets are characterized by a lack of clear upward or downward trends. They are more than just trendless periods. They actively mislead traders. These markets can be viewed as traps designed to deplete traders' resources and capital. Navigating sideways markets requires specific strategies to avoid losses and potentialize gains. Sideways markets can negatively impact mental resources. These markets often lead to the erosion of account balances. Sideways trends contribute to emotional inconsistency among traders. The lack of clear direction in sideways markets can be mentally taxing. Emotional inconsistency can lead to poor decision-making in trading. A trader's confusion can lead to predictable trading patterns. Predictable behavior makes a trader vulnerable to exploitation. Strategic market participants can identify and capitalize on these patterns. This transforms the confused trader into a profitable target. Modern tape reading emphasizes the analysis of order flow to determine market dominance. It involves assessing relative strength by comparing a security's performance to its peers or the overall market. Absorption at extremes is a key focus, identifying instances where buying or selling pressure is counteracted. Volatility assessment is crucial for understanding the degree of price fluctuation and potential risk. These elements combined provide a comprehensive view of market dynamics for informed trading decisions. Identifying trapped participants is crucial in modern tape reading. Determining who is trapped and who is waiting is essential. This identification helps in understanding market dynamics. It provides insights into potential price movements. In trading analysis, price and flow provide distinct insights. Price reflects the level at which a transaction was executed. Flow indicates the entity or group bearing the impact of the trade. Analyzing both price and flow offers a comprehensive view of market dynamics. Borrowed conviction is defined as adopting beliefs without genuine understanding. This adoption often occurs without personal experience or critical evaluation. A key problem with borrowed conviction is the lack of personal ownership. Without ownership, the individual may struggle to defend or apply the belief effectively. Ultimately, this absence of understanding and ownership makes borrowed conviction detrimental. A trader must understand the underlying rationale for every trade they undertake. Understanding the why behind a trade is crucial for effective decision-making. Without a clear rationale, a trader lacks the necessary context to manage the trade effectively. A well-defined rationale informs the trader's exit strategy. Knowing when to exit a trade is impossible without understanding the initial reasons for entering it. Adopting another person's thesis involves accepting their core assumptions. This adoption leads to inheriting their blind spots. The adopter lacks the original data that inform the thesis. The adopter also doesn't share the original risk tolerance. Therefore, adopting a thesis without context creates vulnerabilities. Dependency with leverage involves relying on borrowed conviction. Borrowed conviction means adopting beliefs or confidence from external sources. This reliance amplifies the risk associated with the dependency. The combination of dependency and leverage is inherently dangerous. Highly profitable traders often spend a significant portion of their time not actively engaged in trading activities. This approach emphasizes the importance of patience and strategic waiting in the market. The market as a waiting game suggests that the best opportunities require careful observation and timing. Successful trading involves identifying optimal entry and exit points rather than constant activity. Waiting for the right moment can lead to more profitable trades compared to frequent, impulsive actions. Discipline and restraint are key components of a successful trader's strategy. Profitable traders prioritize identifying and capitalizing on volatility expansion. Volatility expansion refers to a period of increased price fluctuations and trading range. Waiting for volatility expansion is a more strategic approach than trying to profit from contraction. Volatility contraction typically involves smaller price movements and tighter trading ranges. Capitalizing on volatility expansion can potentially offer greater profit opportunities. Successful traders prioritize rigorous validation before investing. They allow others to test and potentially disprove a trading thesis. This approach minimizes risk by avoiding premature capital deployment. Validation helps confirm the viability and profitability of a trading strategy. Waiting for validation is a key risk management technique for experienced traders. Capital deployment should be strategic, aligning market conditions, trading signals, and position sizing. A market regime refers to the prevailing market environment, such as bullish, bearish, or sideways trends. A trading signal is a trigger or indication to enter or exit a trade based on analysis. Position size refers to the amount of capital allocated to a specific trade. Alignment means that the trading signal should be appropriate for the current market regime. Furthermore, the position size should be proportional to the strength of the signal and the risk tolerance. Activity and productivity are distinct concepts with different implications. Engaging in activity does not automatically translate to achieving productive outcomes. Productivity focuses on the efficient and effective completion of valuable tasks. Restraint, or the deliberate choice to avoid unnecessary actions, can enhance productivity. Strategic restraint allows for focused effort on high-impact activities. Prioritizing valuable tasks and minimizing distractions are key to maximizing productivity. Hope can sometimes hinder effective decision-making. It may cause individuals to persist in unfavorable situations. This persistence can prevent the necessary decisive action. Holding on to losing positions becomes more likely when fueled by hope. Therefore, hope can paradoxically act as an enemy in certain strategic contexts. Ego can lead to overconfidence in one's abilities. This overconfidence can foster the belief that one's analysis is always correct. Such a belief in infallibility can hinder objective assessment. Consequently, ego can be a significant obstacle to accurate judgment. Impatience in trading can lead to premature entry into positions. Entering trades too early often means missing key confirmation signals. These signals are crucial for validating the trade's potential success. Ignoring these signals increases the risk of unfavorable outcomes. Premature entry can result in higher losses due to insufficient data. Therefore, patience is essential for making informed trading decisions. Narrative bias involves relying on compelling stories or personal feelings instead of objective facts. It leads to decisions based on gut feelings rather than rational analysis. This bias can cloud judgment, making it difficult to assess situations accurately. Objective analysis requires a systematic evaluation of evidence and data. Overcoming narrative bias involves prioritizing evidence-based reasoning over emotional responses. Overconfidence can be a significant detriment in trading and investment. It often leads to an inflated sense of certainty regarding market predictions. This inflated certainty can cause traders to underestimate potential risks. As a result, traders may take on excessively large positions. These large positions are often based on the belief that a particular outcome is a sure thing. Such over-leveraged positions amplify potential losses if the market moves unexpectedly. The market can incentivize traders to engage in self-destructive behaviors. Emotional decision-making is a key factor in this self-destruction. Traders may act against their own interests due to emotional biases. This can lead to financial losses and other negative consequences. A winning system is designed to safeguard against emotional impulses. It also protects against cognitive biases that can cloud judgment. This protection ensures decisions are based on logic and strategy. By mitigating emotional and biased influences, the system promotes rational outcomes. A robust trading system prioritizes maintaining solvency. Solvency is crucial, especially during periods of market uncertainty. A winning system ensures the trader remains solvent. Maintaining solvency allows the trader to continue participating in the market. A winning trading system leverages asymmetry to benefit the trader. This involves structuring trades where potential gains are significantly higher than potential losses. The goal is to maximize profit potential while simultaneously minimizing risk exposure. Effective asymmetry allows for profitable trading, even with a lower win rate. A risk system is designed to reduce the potential for worst-case outcomes. If a system fails to mitigate worst-case scenarios, it is not a true risk system. Such a system is more accurately described as a wish system. Wish systems rely on hope rather than proactive risk management. Therefore, the effectiveness of a system in reducing negative outcomes determines its classification. The market itself is not the primary barrier to achieving success. The real impediment lies within an individual's own uncontrolled mindset. An ungoverned mind can hinder decision-making and strategic planning. Self-discipline and mental clarity are crucial for navigating the market effectively. In trading, a key challenge lies in overcoming innate human instincts. Traders often struggle against the impulse to prioritize immediate emotional comfort over long-term financial success. This can lead to decisions that undermine carefully planned strategies. Therefore, successful trading requires disciplined management of emotional responses. Success in markets is fundamentally linked to effectively managing exposure to risk. Understanding and controlling market exposure is the first step towards achieving mastery. Exposure refers to the extent to which an investment's value is susceptible to market fluctuations. Effective risk management involves identifying, assessing, and mitigating potential losses. Mastering exposure requires a deep understanding of market dynamics and investment strategies. Ultimately, skillful exposure management is crucial for long-term success in financial markets. Effective exposure control begins with understanding and managing one's emotional state. Emotional mastery provides a stable foundation for making precise exposure decisions. This involves recognizing how emotions can influence perception and judgment. By controlling emotions, one can achieve more accurate and consistent exposure results. Effective emotion management begins with identifying key priorities. Prioritization involves determining what needs safeguarding to achieve future success. This requires a strategic assessment of potential emotional vulnerabilities. Protecting these vulnerabilities is crucial for maintaining emotional stability. Emotional stability is a prerequisite for making sound decisions. Therefore, prioritizing protection is a foundational step in mastering emotions. Survival is the fundamental skill required for success. Effective risk management is crucial for survival. Profit is a result of managing risks effectively. Focusing on survival ensures long-term sustainability. Risk management directly impacts the ability to survive. Prioritizing survival leads to profitable outcomes. Many traders start with the belief that they can control market outcomes. However, the market's dynamics often dictate a trader's actions and decisions. This creates an illusion of control, where traders feel in charge but are reacting to market forces. Understanding this illusion is crucial for developing a realistic trading strategy. Understanding personal risk tolerance is crucial before trading. Risk tolerance reflects an individual's capacity to withstand potential losses. It is important to assess your comfort level with market volatility. Consider the potential impact of losses on your financial stability. Aligning trading strategies with risk tolerance is key to long-term success. The prospect of rapid financial gains can be highly attractive. This allure can significantly impair one's judgment. It may lead to impulsive decision-making in financial matters. Such decisions are often made without proper consideration. The desire for quick profits can overshadow rational analysis. This can increase the risk of financial missteps and losses. Market cycles are recurring patterns or trends in economic activity. These cycles consist of expansion, peak, contraction, and trough phases. Recognizing these patterns is crucial for investors and businesses. Awareness of market cycles helps anticipate potential market traps. It also enables the identification of emerging opportunities. This knowledge aids in making informed decisions and strategic planning. A trading plan serves as a crucial roadmap for navigating financial markets. It provides a structured approach to decision-making, minimizing impulsive actions. A well-defined plan acts as a guide, ensuring consistency in trading strategies. It helps prevent emotional deviations that can lead to poor investment choices. By adhering to a plan, traders can maintain discipline and objectivity. This ultimately increases the likelihood of achieving long-term financial goals. Flexibility is crucial for navigating changing market conditions. Adaptability allows businesses to respond effectively to new challenges. Volatile markets require quick and informed decision-making. Businesses must be prepared to adjust strategies as needed. Successful adaptation ensures long-term sustainability and growth. Patience is a valuable asset in achieving long-term success. Waiting for the opportune moment can yield greater rewards than constant action. Strategic patience involves careful observation and timing. It allows for a more calculated and effective approach to opportunities. Impatience can lead to missed opportunities and diminished returns. Analyzing past trading mistakes is crucial for improving future strategies. Mistakes offer valuable insights into flawed decision-making processes. Identifying patterns in past errors helps refine trading approaches. Effective learning from mistakes reduces the likelihood of repeating them. This iterative process of analysis and adjustment is key to long-term trading success. Staying informed about market news is crucial for sound decision-making. However, excessive information can lead to analysis, paralysis, and overwhelm. It's important to strike a balance between being informed and avoiding overload. Prioritize reliable sources and filter out irrelevant or repetitive information. Set specific times for market news updates to avoid constant distractions. Focus on key indicators and trends that directly impact your investment strategy. Herd mentality involves individuals following the actions of a larger group. This behavior can lead to overlooking unique opportunities. Blindly following the crowd may increase exposure to risks. Independent analysis is crucial for informed decision-making. Avoiding herd mentality promotes individual success and reduces potential losses. Independent thinking is crucial for traders aiming for sustained success. Developing a unique trading style is a key component of independent thought. Crafting a personalized strategy is also essential for long-term profitability. A tailored approach allows traders to adapt to market changes effectively. Trading activities should not dominate one's life. It is crucial to maintain a healthy balance between trading and other aspects of life. An overemphasis on trading can lead to stress and burnout. Balancing trading with personal interests and relationships is essential for well-being. A balanced approach promotes better decision-making and long-term success in trading. Continuous learning is essential in a constantly evolving market. The market's dynamic nature necessitates ongoing adaptation and skill enhancement. Professionals must stay updated with the latest trends and technologies. This commitment to learning ensures competitiveness and relevance in the industry. The market serves as a reflection of an individual's psychological traits. Personal strengths and weaknesses are mirrored in market behavior. Understanding these reflections is crucial for successful trading. Emotional control and discipline are key strengths for navigating market volatility. Impulsiveness and fear can lead to poor decision-making and losses. Self-awareness is essential for identifying and mitigating psychological biases in trading. Identifying your trading personality is crucial for success. Understanding your trading personality aids in strategy selection. Different personalities align with different trading approaches. Aligning strategy with personality enhances trading performance. Fear and greed are powerful emotions that can significantly impact trading decisions. Uncontrolled fear can lead to premature selling, missing potential profits. Conversely, unchecked greed can encourage holding onto losing positions for too long. Such emotional decisions often deviate from rational trading strategies. Therefore, effectively managing these emotions is crucial for making sound judgments. Rational trading decisions are essential for consistent profitability and risk management. Discipline is fundamental to any successful trading system. It provides the necessary structure for consistent execution. Discipline helps traders adhere to their predefined strategies. It minimizes emotional decision-making in volatile markets. Ultimately, discipline enhances the probability of long-term profitability. Realistic expectations are crucial for maintaining a positive outlook. Unrealistic expectations often lead to disappointment. Frustration can arise from unmet, idealized goals. Setting achievable goals promotes a sense of accomplishment. Managing expectations is key to overall well-being and satisfaction.